Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today, and today in episode 19, Variable Annuities, we got another good one for you. Thank you for taking the time to check out the show. Shout out to all of our listeners. I don't have anywhere specific today that we're going to shout out to, so if you're listening to the show, this shout out's for you. Thanks for tuning in. We really appreciate it. Hopefully you're enjoying the show. This is a continuation of our mini-series on annuities. So as I've said in previous episodes, if you have not yet listened to episodes 16, 17, and 18, I would strongly encourage that you do that before jumping into today's episode, episode 19, on variable annuities. Although the last few episodes, including this one, are all a little bit different, they do kind of build on each other. There are some concepts that were introduced previously that we may not go over in detail as the episodes progress. And so it's pretty crucial that you have a fundamental understanding of annuities, what they are, how they work, some general basics. We do that in episode 16. 17 talks about fixed annuities and the mechanics of those, sort of elementary in nature. The last episode, in episode 18, we did indexed annuities, which were a little bit more complicated. And if you're not lost yet and you're really wanting to get extra credit, you've come to the right place. Episode 19 today on variable annuities will definitely make your fucking head spin. So that's kind of where we're at. We're going to continue on and jump into the episode today and go from there. So let's continue on with our theme of pizza. I don't know why I've been thinking and talking about pizza for the past few episodes. We're actually, if you stay tuned to the end, we actually have a pizza challenge that we're going to get to, which is pretty cool. Something I kind of made up and came up with and thought the listeners might enjoy it. We're going to continue on with that theme, I guess you could say. So if we think about a variable annuity, think about what comes to mind for you when I say meat lovers pizza or when I say veggie pizza. That's kind of what the variable annuity is, right? It's loaded down. So if you're into meats like me and somebody says meat lovers pizza, love that shit. Good to go. Let's get it. If you come to me and say veggie pizza, I'm probably going to say fuck you because I am not big on the veggies, right? So some people are going to love these. Some people are going to hate these. There's usually not a lot of in between. As I've alluded to and maybe specifically stated in previous episodes, annuities in general, they get a bad reputation out there that a lot of the financial media personalities shit on and talk badly about, are generally going to be variable annuities. And you'll see why as we go through today's episode. There's some really good things about them. There's some not so great things about them. And you have to be careful just like with anything in life, right? Buyer beware. But we are going to talk about that today. So in the grand scheme of things, if we tie the pizza thing full circle, right? We had the large cheese pizza was the fixed annuity in episode 17. We had a pizza with a sprinkling of toppings that you have to be very selective about because it could ruin it for you or not, depending on what type of contract you chose. We talked about that last episode in episode 18. And this one today in episode 19, we got the meat lovers and or the veggie pizza, which is going to be loaded down. You're either going to love it or you're going to hate it. So buckle up. Here we go. What we're going to talk about when we're talking about variable annuities today are mostly variable, flexible, premium, deferred annuities. And if you've listened to the past several episodes, a lot of those terms should ring a bell. But just as a quick refresher, flexible premium meaning that you can generally continue to make contributions to these contracts over time. That's not always going to be the case, and sometimes there are some significant limitations on the timing of when those premiums can come in, specifically when we get into some of the riders like income riders, and we'll get to that. But generally speaking, these are flexible premium contracts that you can put money into over time. And then they are deferred annuities, right? They're deferred from the standpoint of you are not annuitizing or receiving income right away. In fact, you more than likely, if you're using a contract like this with some of the riders that we'll talk about, you're probably not annuitizing at all. If you don't know what I'm talking about when I say annuitizing, again, you want to check out those previous episodes because we go through a lot of the information there. And in the interest of time and the amount of stuff we have to go through on today's episode, we're not going to be able to revisit all of that right now. But So it is something generally flex premiums can go in. It is a deferred product, and generally you will use it for the benefits that it provides, depending on what you're using the contract for, much later on down the road. That is typically how these are going to work. So that's what we're going to be focused on today. Some super high income earners may use certain types of variable annuities like this for tax deferred growth benefits once all their other tax favored vehicles are exhausted. Personally, I'm not a huge fan of this, but if you look at some of the higher income earners, maybe your physicians of the world, your attorneys and things like that are making all kinds of money, they might look to utilizing some of these vehicles. We haven't done really specific episodes yet on real estate investing. They are coming at some point. I do want to get to that. We're trying to do this piece by piece, chunk by chunk, and we haven't gotten there yet. I would argue there's other ways to invest money in certain asset classes and investments that can have tax advantages. I don't think that the annuity is the be-all, end-all. Unfortunately, a lot of financial advisors out there will tell you that that is the case. And again, it can make sense in certain situations, but not necessarily for everybody. So be careful there, but you will see some people utilize these strictly for the tax deferral, because as long as the funds are in the contract, just like any annuity, any gains that are experienced in the contract are all going to be deferred until money is withdrawn. So that can be, for those that are in very, very high tax brackets, somewhat appealing to them. Also, and this is kind of dog shit too, if you work for a fairly small employer, you may be surprised to find out that your retirement plan at work, if you have one, may be funded with some sort of variable annuity, which in and of itself isn't necessarily a bad thing, although I have a fundamental disagreement with the way that a lot of those plans are structured. And generally speaking, if you are going to work and getting a paycheck and making contributions to a retirement plan over time, a variable annuity is typically an extremely expensive way to do that. And there are way more cost-effective and lower cost, lower fee options in terms of how those plans can be structured. The most common is going to be mutual funds. So if you have a mutual fund-based plan, again, those fees can also be high in some cases, but generally speaking, it's going to be a lot less than variable annuities. So the takeaway there is, if you don't know, especially if you work for a smaller employer, you may want to contact your HR and benefits office to check out your retirement plan and figure out whether or not it is mutual fund based or annuity based. And if it's annuity based, doesn't necessarily mean you shouldn't participate, but you want to take a look at what those fees and expenses are for the value that you're getting. And you may, for example, decide you only want to put in up to the point of the match if there is one, or if there isn't one and you're not maxing out other types of retirement accounts. Think about Roth IRAs. Go back to the episodes on those if you'd like to. You may want to consider that first. So again, not going to spend a lot of time on it, but you do see variable annuities in a lot of cases in some of these smaller plans out there. Most people will use certain riders, generally lifetime income riders. In some cases, we'll talk briefly today about enhanced death benefit riders on variable annuity contracts. We are going to mostly focus on lifetime income in this episode, which in my opinion, both personally and professionally, should be the primary use case for these types of contracts. Okay? There's always going to be an exception, but generally speaking, that's the way I think about it. If you have a variable annuity and you're not some super high income earner that needs every single tax break you could possibly get, and you have not taken the time to explore or are not willing to explore other investment avenues, okay, fine. But other than that, you, in my opinion, should be looking to potentially use something like this for certain lifetime income benefits if it fits your situation and if it fits into your plan, as I've said ad nauseum on all these different episodes now. So that's where we're going to spend the majority of our time today. But before we do that, let's first break down the different components of a variable annuity. All right. So this is a little list that I made with some different ranges based on contracts I've seen. It is fairly comprehensive, but as I've said before, it is not exhaustive. So take the time, do your own due diligence, do your own research. This is not necessarily an exhaustive list, but it should give you an idea of things to look for and where to get started. And quick disclaimer, as I've said on pretty much every show now, there is no advice being given on the show. We do not provide legal, tax, financial, or any other advice on the show. We do this for entertainment and education only. Always consult your own professional for your own specific situation before you take or make any financial decisions. So now that we have that out of the way, let's go ahead. So variable annuities. First, one of the things that's very different about these types of contracts versus the other two we've talked about, which are fixed annuities and indexed annuities, is that there are some underlying variable investments. And when I say variable, if you're investing at all or have ever invested, this is pretty much what you're already probably going to be used to. So if you've ever put money into a retirement plan, for example, or in the stock market at all, you'll notice that based on how your specific investments perform and how the market is doing in general, that you will see both fluctuations upwards and downwards in those investments. That's what I mean when I say variable investments. So these variable contracts or variable annuities will have an investment component. All right. So if somebody is selling or trying to sell you a variable annuity, chances are they better have a securities license in order to do that, which again is a little bit different than what we talked about last episode in episode 18 with the indexed annuities, where you only need an insurance license to be able to offer those products. These variable annuities, these variable investments, they're similar in a lot of ways to what most people are used to, which are mutual funds, but technically they are called sub-accounts. So if you hear somebody talk about variable sub-accounts, those are the underlying investments inside of this insurance contract, inside of this variable annuity contract that function almost identically for all intents and purposes as a mutual fund, okay? They will have an expense ratio similar to what a mutual fund has. Depending on the type of variable annuity contract that you have, you could have expenses pretty much all over the board. So generally they're going to be anywhere from about 0.5%, so 50 basis points, 0.5%, all the way up into 1% plus. So generally the range I've seen out there is about 0.5% all the way up to 1.15, maybe in some cases 1.25, something like that for the investment component is an expense ratio of these sub-accounts in the variable annuity. So that's going to be one layer essentially of the contract and one layer of fees. And we're going to stack fees on fees on fees here in a second. And that's why, as I mentioned at the top of the show, when we're talking about meat lovers, that thing's fucking jam-packed, right? You got pepperoni, you got ham, you got sausage, you got hamburger. And by the way, I don't know where pizza shops got this, but in my opinion, it should be sausage or hamburger. Who the hell wants sausage and hamburger on a pizza? But that's besides the point. Anyway, you got sub-accounts and expense ratios, right? So that's to start with. And then you'll have something else called the M&E, which stands for mortality and expense charges. And if you're not looking carefully, this is something that can oftentimes be overlooked, especially if you don't know what you're looking for. It's technically going to be in the prospectus, and they should have it in some of their marketing material in the fine print. But if you're only looking for the expense ratios on the sub-accounts, you may very well forget about the M&E that's going to be on a variable contract. So these also can be across the board anywhere. It's basically the same range, but usually anywhere from like 0.45% on the lower side all the way up to maybe 1.25%, 1.25%. And this is going to cover sort of a standard, what's called a guaranteed death benefit, which we'll talk about in a second. It's also going to cover commissions and things like that. It's pretty much, I hate to say it, but it's a fucking bullshit charge that's in a variable annuity contract. And it has some merit, but there's a lot of profit baked in there as far as that goes. When we talk about guaranteed death benefit on annuity contracts, generally the way that that's going to work is that if, let's say somebody puts money into a contract, so say over time somebody puts premiums or contributions in, and for ease of round numbers, let's say it totals up $100,000, okay? And they've never made a withdrawal from the contract, and then it's a variable annuity, right? They have variable investments that can go up and down. The market crashes, their sub-accounts go down in value, and the account's worth, say, 70 grand, and then they die. Well, their beneficiary in most cases is going to get the higher of what they put in or what the account is worth. So they put in this example, $100,000. The account at the time of death in this example is $70,000. Their beneficiary would therefore receive the $100,000 that was put into the contract initially, which is kind of a nice feature. But at the end of the day, when you crunch the numbers and you do this out and you realize what you're paying for that year over year over year, it may or may not be necessary. And I'll talk a little bit more about enhanced death benefits in a little while, and I'll give you some more thoughts that I have around that. But that is essentially a guaranteed death benefit. The beneficiary is going to receive the greater of contributions or premiums paid into the contract, minus any withdrawals that they take, or the contract value at the time of death. So if they put in 100 and the market went up, and it's worth 130 and they die, beneficiary gets 130. If they put in 100, the market shits, it goes down to 70 and they die, beneficiary would get 100. That is your standard guaranteed death benefit that's going to be part of the contract, okay? The next layer of fees that you may or may not see on a contract are administrative charges. Again, I hate to say it, A lot of these companies put out these really nice, colorful, glossy brochures, and guess what? Somebody's paying for that, right? And it's going to be the contract owners of these variable annuity contracts. So in some cases, there isn't a separate administrative charge. There's enough meat on the bone, right, to take care of that with some of the other fees and expenses. But some companies are, pretty much just stick it to you and make you grab your ankles, and they could charge you anywhere from 0 to, say, 0.25% in some cases, right, 0.25% for administrative charges. Then, if that's not bad enough, right, and if administrative charges is equivalent to grabbing your ankles with a little bit of lube, maintenance charges is no lube coming in, and they could often hit you with another small fee. And this is typically very small, but usually anywhere from $25 to $50 a year for maintenance charges. Again, personally, I think it's a bunch of bullshit. Some companies do this, some companies don't. Most of them, however, will waive the maintenance charges for contracts of a certain value. For some companies, it could be a very large number. They might waive it if your contract value is $500,000 or more, but oftentimes it's less than that. It could be $50,000 or $100,000. If you have at least that much in the contract, basically because they're sucking enough fees out of you, they're going to go ahead and waive that little maintenance charge for $25 or $50 a year. But if you start one of these things and you don't have that much money in them, be prepared to get feed to death. That's just the way that it works, unfortunately. So again, these are some of the reasons that these types of annuity contracts get a bad reputation, because they're often misused. No one's explaining these different layers of fees. And so far, everything we talked about up until this point, right, other than the guaranteed death benefit, right, the standard guaranteed death benefit, and the ability to invest inside of a tax shelter, which, by the way, if you have a retirement plan, you already have a tax shelter of some kind, so you don't need an annuity, which is one of my major beefs with the fact that some of these retirement plans are funded with variable annuities. If you are investing outside of a retirement plan, again, you're a high income earner, then the tax shelter could be worth it for you. But so far, all we've really talked about as far as the benefits of this versus another type of normal, quote unquote, mutual fund or exchange traded fund type of stock market investment is tax deferral plus guaranteed death benefit. And we've gone over several layers of fees in order to get that. And for some people that are buying these contracts, that's all they're getting, or they're not using them for anything else. I think you're grossly overpaying for what it is, okay? However, there are some other riders that you can put onto the contract, which we haven't talked about yet and we're about to get into. And this is where I think these can be worth it in certain situations. So before I get into that really quick, like we talked about on some of the other annuity contracts, specifically fixed deferred annuity contracts and then indexed annuity contracts, which are also deferred contracts, there can be, and oftentimes almost always are, what we call surrender charges. So if you remember back to those episodes, surrender charge is essentially a commitment period that you need to remain in the contract, and if you take out too much too soon within that first however many years, anything above and beyond what's called the free out percentage oftentimes, which is the amount that the insurance company will allow you to withdraw during that initial period, anything above and beyond that will generally be assessed a surrender charge or a surrender charge penalty. Some people call it a surrender fee. It's basically the same thing. These charges will only apply, again, if you take out too much too soon, but it is important to realize that they are there, especially if you're in a contract for a few years. Let's say you have a 7-year contract and you're in for 3 years, and for whatever reason you want to change your mind. Unfortunately, almost always you're going to be stuck, or you're going to have to pay significant surrender charge penalties to get out. But if you've done your homework up front, you know what you're getting into, you've talked with your advisor / agent / whomever, you have a plan and a strategy, then hopefully that's not going to be a concern for you, and those surrender charges would never really even come into play. So if you stay in the contract and you play by the rules, the surrender charges essentially become irrelevant. Now we're going to get into the rider fees. So you may have income rider fees, which we'll spend the majority of our time on. You may also have what they call in some contracts enhanced death benefit rider fees, which I think is a crock of shit, and I'll tell you why. You can see, though, after going over all these different layers, that these contracts can get very expensive in a hurry. And it's not uncommon, depending on the contract and depending on the riders you're using, if any, and the sub-accounts that you're using, and whether or not they're going to waive the maintenance charge, and whether or not they have an administrative charge, and how high their mortality and expense charge is or are. It's not uncommon, though, for these to be all in somewhere in the 3%, some cases even 4% range. You may find some lower cost VAs, variable annuities out there that could be in the 2s. It's very uncommon that you're going to find anything lower than that. although I will make a comment coming up here in a little bit about some of these newer, less expensive contracts that have some really watered down benefits and almost aren't even worth looking at. But anyway, you're all in probably going to be about 3-4% in terms of your annual fees and expenses to be in a contract like this. So what does that tell you? Well, if I'm going to put money into a variable annuity or anything for that matter, and I'm going to pay those types of fees, I damn well better be getting my money's worth, and there better be some really cool things happening in that contract for me to make it worth it for me to put my money in, right? So let's get this one out of the way. The enhanced death benefit riders. I've seen these all over the place, and different companies calculate this differently. I've seen it as low as 0.15%. I've seen it as high as 0.65%. So somewhere in that neighborhood. And basically, as far as the death benefit goes, we talked about your standard guaranteed death benefit where you're going to get, or your beneficiary would get, the higher of contributions or premiums put in, or what the account's worth, the account value when you pass away, right? That's typically standard. That's included in the M&E. But if that's not bad enough, if you want to play some fucking magic tricks and potentially have an enhanced or a higher death benefit value for your beneficiaries, well, you can add some of these enhanced death benefit riders on there, or you can add one enhanced death benefit rider. Some companies don't have them at all on the contracts. Some will have 1 or 2 options. I saw one company out there that had like 4 different options in the same contract, and they vary, right? Some of them will just say it's going to be a return of premium only. Some of them will do a return of premium plus a compounded interest rate, say 3%, for example. Other ones will do what's called a high watermark or highest anniversary value, where they take a look at, the contract and they make adjustments that way. They're playing a bunch of different games, and you're paying for this through the nose. In my opinion, it has very, very limited use cases. In fact, I know of somebody who is a financial advisor, and I don't know all of their client details, but there was sort of an internal call at one time. And the story was told about this advisor had a client, and that client had a bunch of money that they wanted to leave to one of their children. And so they decided, well, why not try to grow the money as much as possible? Hence, we're going to use a variable solution. But at the same time, if the market moves against us and goes down, we don't want to have them inherit less. So their solution was a variable annuity with an enhanced death benefit on there, right? An enhanced death benefit rider on there, so that the beneficiary would inherit a whole bunch of money. Now, on the surface, it sounds good, right? What's wrong with that? No big deal. If you dig a little bit deeper, though, this contract was outside of a retirement plan. So these were non-qualified or non-retirement dollars that we're talking about. And there are some very special rules. It gets a little bit complicated, but generally speaking, especially in this case where it was a non-spouse, right? But there is something called the 5-year rule on what's called a non-qualified deferred annuity, or an NQDA type of contract, where in this case, if and when the child inherits the contract, they're typically going to have to liquidate the entire amount within 5 years of the date of the owner's death. In this case, this person's client, this advisor's client. And so it sounds cool on the surface that they're going to inherit this money and they're doing all they can to make this number as big as possible. It really, and I don't know anything about this client or the client's child, but presumably, generally speaking, when clients pass away, they're quite a bit older. If they have children, at that point, they are adult children that, generally speaking, are going to be mid-career. Hopefully, they're doing fairly well financially, which means that presumably they're going to be in a fairly high tax bracket. And now you're going to take a big chunk of money and force it down their throat, essentially, within a 5-year period that they have to liquidate this contract. Because remember, all the gains on the contract are going to be taxable at ordinary income tax rates. And on the surface, I didn't think this was a very good solution. My first thought was, well, maybe this advisor did this, I don't know. But maybe they should have been looking at something else, like life insurance, for example, where the beneficiary, in this case, the advisor's client's child, would have inherited that when the client passes away, income tax free. And they have a lot more flexibility and a lot more options. And depending on this particular client and some other needs that they might have, if you remember back to our life insurance episode where we talk about different living benefits that can be on a life insurance contract for things like chronic illness and long-term care and things along those lines, it's possible that they could have accomplished multiple things, multiple goals with the same quote-unquote investment, if you will, as opposed to this. And the reason this was brought up on a call was that this particular advisor earned north of a $40,000 commission on this particular sale. And I'm all about, as the cash flow king, making money just like the next person. But given what I knew about the situation, and I mean, the compensation kind of stands on its own, but I honestly don't think that this was probably the best solution. Maybe it was. Maybe this advisor did their due diligence, and again, I don't know everything about their client in the entire situation, but I think there were some other questions that should have been asked, that could have been asked, that may or may not have been asked. I don't know. But everybody was so busy celebrating the fact that this advisor earned a $40,000+ commission, which I know some of you listening are probably shaking your head, and I thought it was quite disgusting. I actually thought that I was probably one of the only people that didn't, mention or say any sort of congratulatory comment, because I think they should have talked a lot more about not just how much they made on the sale, but about the process and the other solutions that they explored, and really how this was actually really truly in the client's best interest. And again, maybe it was, maybe it wasn't, I don't know. But I think a lot of people in financial services are so fixated on making a buck that sometimes it's easy to overlook some of the other factors. So why do I bring that up? Well, I don't really know, other than it was a recent thing that happened, but also because if these enhanced death benefits were such a great fucking thing, right? Would they really, and of course there's more to it than that. There's several layers of fees, but a $40,000 commission on one ticket, I mean, that's a pretty good payday, but at the same time, I just don't think that it's the best solution. In this particular case, with the whole 5-year window, again, it just makes me really scratch my head. Anyway, so that is one use case, and in this particular example, that is a way that it was used to place business. I don't think that for most people, enhanced death benefit riders are the way to go. Now, I could be completely wrong. Maybe this advisor went through the process and their client was uninsurable and they had major health issues and they didn't want to take a look at any other options. They didn't want to look at a brokerage account that, the child would get a step up in basis when they passed away, which is another favorable item. Maybe for whatever reason, this could have been the best solution, but I think there are very limited use cases for the enhanced death benefit rider. So we'll just leave it there. I went on way longer than I expected to on that. The reason that most people are using variable annuities, again, are for the income riders. So let's talk a little bit about the income riders. The income riders, a lot of them will have certain investment restrictions, and typically there is a maximum equity or stock market-based percentage that you can have in terms of allocations within these contracts, right? So they might say, well, you can use this type of portfolio. A lot of these contracts have what they call volatility controlled type of portfolios where they're not going to let shit get too far out of whack. Other ones will say, well, you can pick and choose your own investments, but you can't have more than fill in the blank, 70%, 80%, 90%, whatever it is in equities or stock type of allocations. And the reason is when you slap on these income riders and you're using it for guaranteed lifetime income, presumably in retirement, if the contract has substantial gains and these income features are attached to these contracts, the insurance companies can be on the hook for paying out a lot of money over many, many years. So in order to reduce their risk, not only do they have to charge these fairly healthy fees on these contracts, but they also have to put some parameters in place within which you have to remain as far as investment allocations go to make sure that you might hit some singles and doubles and triples and occasionally hit a home run, but they're going to do everything they can to prevent you from hitting a grand slam, right? They don't want to be on the hook for some exorbitant amount. So they're pretty good about managing risk, as you might expect. After all, these are insurance companies, right? So there's probably going to be some investment restrictions in terms of a max equity percentage or certain types of pre-made portfolios that you have to choose from on these contracts. The rider fees themselves, they're going to be a little bit different, right? Some of them, I've seen them in, there was one contract out there that was between a 1.3 and a 1.5% maximum that they could charge on just the income rider in addition to all the other fees that we talked about already. There was another one out there I looked at. It was at 1.45%, but it was tied to the VIX, the volatility index. And so every quarter the fee could adjust up or down depending on what's going on in the markets. So when there's a lot of volatility, a lot of up and down, a lot of turbulence, and you really quote unquote need that rider in place for those income benefit protections, then the fee has the potential to go up a little bit. And if the markets are fairly flat or stable and there's nothing crazy going on, right, the fee could actually decrease. So you want to take a look at that and see what the max, just like on the index contracts, you want to know what the maximums and minimums are, that those things can adjust over time to try to get a sense the best that you can of what you're getting into. But do know that the fee can change, and in some cases, on some contracts, and in some cases, that fee can actually go up a little bit. These contracts and these income riders, believe it or not, can be some of the most generous lifetime income riders of all annuities, but as you might expect by now, the fees are also typically the highest. And as I mentioned a minute or two ago, there are some lower cost variable annuities that are out there now where they have some sort of watered down living benefits, but the fees are a lot lower on those. And there was an article that came out a few weeks ago that I was reading where so far the research pretty much says that they're really not worth it. If you're going to use this approach to retirement income planning, then the gist of it, and I'm paraphrasing here in my own words because this is Real Talk Personal Finance, but the gist of it was pay the fucking fees if you want the benefits, or do it a different way and don't pay any fees, but don't use the shit in the middle, which are these watered down benefits at these slightly reduced costs. It's just not worth it. That was essentially the consensus of the piece that I read. Some of these contracts and some of these riders will provide higher income early on, and we alluded to this on the previous episode, higher income early on and potentially lower income later if and when the account value goes to zero. So remember back to episode 18 on indexed annuities where I said the majority of the time on the index contracts, whatever percentage that you're taking of that benefit base, remember we did the T, we had a piece of paper, we drew a T, right? The left-hand side was the account value, the right-hand side was the benefit base. Sometimes it's called the income base, the number in the fucking clouds. None of that changed, and that's going to essentially carry over and be the same thing here. But when we talked about it on last episode on indexed annuities, whatever percentage of that number in the clouds that you were going to receive for lifetime income, generally those did not change on those contracts. And you may find an index contract out there where it does. Again, this is designed to be comprehensive, not exhaustive, so do your own research. However, most of the time, those will remain level throughout the life of that owner/annuitant. On the variable contracts, however, that can also be true, but there's a lot of options out there on the variable side that we're talking about today in episode 19, where you may start off with one level of lifetime income, and that could change, and it could potentially go down over time in the contract. And we'll see some examples here at the end. I actually have a bunch of examples. I'm not sure if I'm going to get through them all. We'll see how we do on time. So some of these will provide higher income early on and potentially lower income later. And you might be thinking, why the hell would I ever do that? Well, if you think about it, most people, when they're newly retired, they are generally fairly young or younger than they're going to be obviously later in retirement. Maybe they've been working their entire lives or careers, right? And they have more time than they've ever had, and they want to see things. They want to do things. They want to go places, and generally that means they're going to be spending some money. So their expenses early on in retirement are typically going to be a little bit higher than they might be later on in retirement when they're at home and their health might decline. Maybe they're not doing as much, therefore they might not be spending as much. And so companies have kind of smartened up to this, and they've designed certain contracts and riders out there to coincide with this pattern of spending. There's something out there called the retirement smile. So if you just picture like the little smile on a smiley face after you had a piece of meat lover's pizza, right? It starts off a little bit higher, right, on the top left. So spending might be high, and then it might slowly decline and kind of hit a little bit of a trough there for a little bit. And then all of a sudden, way later in life, towards the end of retirement, health starts to become more and more of a concern, and healthcare costs will generally rise, and it kind of ticks up again and goes back up to the right-hand side, hence the smile. So everyone's spending patterns are going to be a little bit different, but that is something that is fairly common for a lot of retirees, and therefore some of these contracts are designed with that in mind. Most of them will give you a choice, and we'll go through those in the examples of how you want to receive lifetime income and what that might look like for you. And you can essentially, if this fits into your plan, choose the rider and the option that is going to make the most sense for your anticipated spending. So that's kind of nice. And as I said, other riders, including some of these on the variable, but you see this most often on the index contracts especially, will provide level lifetime income, right? So just like on the fixed and the index contracts, it's going to be a level lifetime income amount that's paid out. And there's clients that use variable contracts where they don't want to know that their guaranteed lifetime income is ever going to go down. They are okay with knowing, here's what I'm getting now, and I know that that's never going to change in the future. If anything, it will go up, it will never go down. Some people find a tremendous amount of comfort in that. And some people, again, their spending patterns may be such that that's what they want, and that's fine. These variable annuities, in my opinion, are going to be most appropriate for clients that have a higher risk tolerance and or those who want a chance, and in some cases a guarantee, not always, of growing their benefit base. And remember that number on the right-hand side of that T that we talked about in detail in the last episode. They want to grow that benefit base significantly or have a chance to grow that benefit base significantly. So we're going to get into some examples really quick. Before I do that, I'll just throw this out there as a general statement, and that is, if you have longer until you need lifetime income, so if you are in your early 50s, maybe even your mid 50s, and you're not expecting to need income for 7 years, 10 years, 12 years, 14 years, something like that, and your risk tolerance is moderate to aggressive, then I think a variable annuity, again, if you decide to go with sort of this methodology for retirement income planning purposes, could make sense. I think it could make a lot more sense than some of the other contracts out there. It's not going to work for everybody, but I think this type of contract is going to be most appropriate for those clients that have more time. In an effort to try to make apples to apples comparisons and be consistent with the previous episodes in the mini-series, what I did was I ran some examples, but I used the same $500,000. I used, just like in the last episode, a client purchasing a contract at age 60, delaying or waiting 5 years to take income, and starting lifetime income at age 65. So this is pretty much the same as episode 18 on the indexed annuity contract. So I did that to keep it simple, because if I did a 7, 10, 12, 14, 15, however many year delay on a variable contract, the results would obviously be quite a bit skewed, quite a bit higher, significantly higher, more than likely. And I don't want to give anybody a false sense of what we're talking about. So I'm trying to, even though these are 3 different types of annuities and they're all going to have their differences, I'm trying to make it as consistent as I can be when I go through these hypothetical examples, right? So let's go ahead and get into that. Looks like I did first contract with that had 2 different riders, and each rider had 3 different methods. You don't really, you can take notes on this shit if you want to. You really don't need to. I'm going to try to hit it high level, but I did that. And then it looks like I looked at a second contract, and that second contract only had 3 different riders on there. So let's start with the first one. So and I'm not going to name any names, insurance company names, contract names. It's not about selling shit. That's not the point of the show. Again, this is for education, entertainment purposes only. This is to give you an idea of what this could look like for you. You're going to, again, want to consult with your own professional, blah, 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 do all your own due diligence, blah, 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 figure out your own shit, blah, blah, blah. Right? But here's some examples that could shed some light on this. Here we go. Contract number 1. Rider number 1, method number 1. So you like my little labels here? Pretty straightforward. Contract 1, rider 1, method 1. So again, we put in $500,000. We're age 60, and we're going to delay and take lifetime income starting in 5 years at age 65. We are not annuitizing. We have added a lifetime income rider onto this contract, and we will be using it to generate lifetime income. That's what we're talking about. So in this first contract 1, rider 1, method 1, it started off in terms of the percentage of that benefit base. Remember that number in the clouds on the right-hand side of the T of how much, we're going to base our lifetime retirement income on that number. What percentage can we take? Well, under this method, it started off in the low 6 percentages, right? The low 6s. So think like 6.2, 6.25, 6.3 in that neighborhood. That's where it started. And then it ended, remember, if the contract goes to 0, the number on the left-hand side that we talked about in the last episode. So this is the same, right? We have a number we start with. We draw the T, $500,000 on the left. That's your account value. That's the cash value. That's the amount of money that is liquidatable, right, at any time, although you may have surrender charges if you do it too early. The right-hand side initially and only initially will be equivalent to that same number, in this example, 500,000, but that's the number in the clouds that we play the magic tricks with, and we try to grow that over time, right? That's the number. Percentage of what? Percentage of the number on the right that we're talking about. So we start in the low 6s. We end up, once the account value goes to 0, in the low 4s. What does that mean in English? Well, in this particular contract, for contract one, rider one, method one, we started at about 65 grand a year. So just over $5,400 a month is the income we were generating. And once the account went to zero, that number dropped down to about $44,000 a year, which is almost $3,700 per month. So our retirement income started off at $5,400 a month and change, and then it dropped down to just under $3,700 a month once the contract value went to zero. Again, think retirement smile, right? Where we might stop at the middle of the smile because it doesn't tick back up after that. It just simply starts higher and then potentially could get lower, but you get the idea. Contract number one, same contract. Rider number one, same rider, but they let you choose a different method. So if we went with method number two and we said, okay, well, instead of starting in the low sixes and dropping to the low fours, what if we did something different? How much do we get if we start in the low sevens, but then if the contract goes to zero, we drop to the low threes? What if we want even more income now and we're okay with even less income later if the account goes to zero? What does that look like? Well, in this case, it started at around $75,000 a year, guaranteed lifetime income, which is $6,250 per month. And then when the account goes to zero, which inevitably will happen, could take 15, 20 plus years, the income would drop, in this case, down to just under $34,000 a year, which would be a little over $2,800 a month. And again, these are ballpark numbers here, so I'm rounding, but just to give you a general idea. Same contract, contract one, same rider number one, but now the third method, the third option on that rider, which would be, what if we just want to take out a percentage and we don't want it to change? I don't care about starting higher and going lower or starting way, way high and going way, way low. I just want something kind of middle of the road. What do you got? Well, in this example, it came out to 5.15% for life. There's no drop off, so that's a lifetime number. And it started just under $54,000 a year, which was just under $4,500 a month, and that will continue forever. So for some people, again, that like that stability, that like just the peace of mind of knowing that their income is not going to go down at all, it's not going to change, it's a matter of preference. And again, you need to fit this to your own situation, right? You could pair up, for example, if you had more earlier, right, and you're trying to spend something down, you could pair that up with early retirement. Maybe you're not getting Social Security yet. Maybe you have a pension that you're choosing not to receive right away so you can get a larger pension benefit, right? Maybe you don't have a pension at all. Maybe you want to spend down some assets. Maybe you want to do some Roth conversions or partial Roth conversions. Maybe that fits into your plan. So you could choose to have a rider that you're going to spend down with a higher number earlier in retirement, maybe delay Social Security, for example, to get a bigger Social Security check later. And then if and when the contract goes to zero and your variable annuity income drops, not a big deal. Because guess what? At that point, maybe, and this is all hypothetical, but according to your plan, maybe at that point, Social Security kicks on for you, right? Maybe you're going to delay till 70, for example, right? So that's an option. Other people, again, might find comfort knowing that the lifetime income stream is never going to go down, and they might want the level option. That's the one we just talked about. So whatever fits your situation, but these are just on the same contract, same rider, 3 different ways that you can take income. And you would generally elect that when you start the contract. Some companies, once you elect it, that's it. Sorry, you made your decision. Other companies will say, well, guess what? We had that layer of fees and we love fees. Throw some fucking hamburger on top of the sausage, even though it makes no sense, on that Meat Lover's Pizza, and we're going to charge you another fee, and we will let you make a one-time change. So if you chose method 3 and then you said, fuck it, I want method 2, no big deal, pay this fee, we'll change it for you, boom, good to go, right? That's an option on some contracts with some companies. Not all companies will do that. All right, continuing on the example. This is the same contract, but now, remember I said there's 2 riders on this first contract. We went through the first rider that had 3 different methods or 3 different ways you could use that rider. This is the second rider, and there's also 3 different methods with which you can use this second rider. So again, really quick, mid 6s to low 4s on this one. So you could start in the mid 6% area, like say 6.5, for example. That would drop down to the low 4s if the contract value went to zero. So you might start close to, say, $48,000 a year. That might go up over time, actually. Under this particular rider, it did. So when I ran this one, it started at about $48,000 a year, which is $4,000 a month. Based on how the rider's structured and the fact that remember, that number, that benefit base in the clouds, we're doing fucking magic tricks and shit. And that went up over time. So now their income went up, in this case, to about $74,000 a year, which is a little over $61,000, almost $6,200 a month that they're getting. And that happened around age 80, by the way. So again, we purchased at 60, we started income at 65, we're getting $4,000 a month to the face at 65. All of a sudden, around age 80, we start getting over $6,000 a month to the face, and then the contract goes to zero because we feed it to death. We withdrew a shit ton of money. The market may or may not have cooperated with us. Now that's at zero, and we say, fuck, right? What happens next? Well, the income drops. In this case, in early 90s, if you're still lucky enough to be alive by then, it dropped down to about $49,000 a year. So right around close to where it started. And remember, we said mid sixes to low fours. So you're thinking, well, wait a second. If we started in the mid sixes and then we drop down to the low fours when the contract goes to zero, how is the starting income and the ending income the same? And the answer is, remember the number on the right that we're playing tricks with? That number grew significantly over time. So even though we were taking 6% of it, or mid 6 percentage points of it initially, right? Over time, that number went up so that when it finally dropped off and we went down to the low fours of what? Low fours to that magic number, which is now hugely inflated. And so coincidentally, it happened to be right around the same amount of income. So that's, again, part of the benefit and one of the powers of these types of contracts. Yes, they will fee you to death, but if you use them right, you can get a lot of income out of these things. Same contract, contract one, same rider, rider number two, but now we're going on to the second method or the second option or way to use that rider. You can start in the high sevens, right? And you could end up in the low threes. So quite the roller coaster, but you could start off at about $57,000 a year, which is about $4,750 per month. Over time, that number in the clouds grows. And in this particular illustration, it went up to about $71,000 a year, so just under $6,000 a month, and that happened around the late 70s for that person, and then drops to just under $30,000 by their early 90s. And you're probably not getting out of bed much at that point if you're still able to wake up. So the fact that it dropped, some people might say, hey, I don't give a shit. I spent a shit ton of money in my early years. I was, still relatively young, having fun, running around, doing whatever, traveling, and that's what they wanted. Great. You might choose that method number two on that second rider in this example. And then finally, contract one, right? Same contract. Rider two, same rider we've been talking about recently. But now the third option or the third method is you want that level lifetime income, right? So remember the first rider, it was 5.15% for life on this contract. On the other rider, on method three, well, this rider, method three, is 5.30% for life. And you might say, why would I ever use rider one if I can use rider two and get 5.30% of that number in the clouds for life as opposed to 5.15% of that number in the clouds for life? And the answer is because it depends on how the rider looks at that number in the clouds. And in this particular illustration, even though we had 5.3% distribution rate, we started at about $39,000, which is $3,250. We jumped up to $52,000 by age 70, which is $4,333 per month. And we topped out at about $74,000 by age 80, and then that pays forever, right? So on the rider one method three, you had $4,470 across the board. On rider two method three, you start lower at the $3,250, even though it's a higher distribution rate. The way that they do the magic tricks on that benefit base are a little bit different. So you start off with a lower number, right? You go up over time at age 70 to almost the starting amount under the first rider. And then it tops out at 74 by age 80, and it pays forever. So basically, depending on how you wanted to structure it, it would take you several years to overcome what you would have started with on the first rider. So the distribution percentages are the same. Those will never go down, but how they calculate that benefit base and that number in the clouds are different. So on the first case, it was the benefit base doesn't do any magic tricks. Once you turn on the income, that's it. Boom. What is the number? And so that's why that number stayed the same. And even though the payout rate stays the same on this method three, rider two, contract one, the income is going to be all over the place because they are still manipulating the benefit base. The payout percentage does not change, but the number in the clouds does change. And I know that's probably really confusing. I guess I can sum it up and say that it's a matter of preference. You need to match the income rider and the method with your income needs, right? You want to look at the retirement smile spending versus your actual spending versus Social Security optimization versus tax optimization. There's no easy answer. That's why you need to fit this into your plan. What are you trying to do? How much income are you trying to generate? what is the method with which you want to try to generate that income, and which of these methods sounds most palatable to you, and then you kind of run the numbers and back into what's going to work best in your particular scenario. So again, the takeaway here is just because you see a higher payout rate or a higher distribution rate doesn't always mean that you're going to generate the highest level of income in dollars by doing that. Because remember, we can play all kinds of magic tricks with that benefit base, and we will, right, as the insurance company, and you want to make sure you're matching things up accordingly. So you always want to work with your own professional. Really quick, on the second contract I looked at that only had 3 riders, same example, you start with $500,000, you start at age 60, you basically let it do its thing for 5 years, and then you start lifetime income. Under rider 1, they had 5.5% for life, so that it started at $37,000, so a little over $3,000 a month, and it never went up. Dog shit. Same contract number 2, rider number 2, it started in the mid 6s and then went down to 4%. So it started at about $44,000 or $3,666 a month, and it dropped down to $27,000 in their early 80s, $2,250. Not a huge fan that way. And then finally, the second contract with rider number 3 started in the mid 7s, dropped down to 3%. So it started at $51,000 or $4,250 a month. Then it drops to just over $20,000 when they hit 81. That may or may not work for the individual. So again, every contract and rider are going to be different. You want to examine everything carefully, use reasonable assumptions, and make sure it fits into your overall plan. Looking at these withdrawal percentages, we can somewhat make a comparison of what we're going to talk about on an upcoming episode about the 4% rule, and more on that next time. We don't have time to get into all that today, but just think about distribution rate or payout rate, however you want to think about it. That is one metric that is going, we're going to circle back to that on one of the upcoming episodes and try to draw some parallels between what we've talked about here and what we're going to talk about on future episodes. Really quick on the pizza challenge that I mentioned at the top of the show. So by the way, that pretty much rounds out our episode for the content portion, but this is kind of important too. We're going to do a pizza challenge. So if you think we earned it and you would like to leave a 5-star review, please do that. And if you leave a 5-star review and you take a screenshot of that 5-star review, I want you to send that and send an email to realtalkpersonalfinance@gmail.com. Again, that's realtalkpersonalfinance@gmail.com. I want you to send me a screenshot of your 5-star review, and I also want you to tell me your favorite pizza. And I'm going to put all those together, and we will do a drawing for an e-gift card. I will send a lucky winner an e-gift card to get some pizza, because all we fucking talked about for the past 4 episodes, 3 episodes at least, maybe even 4, are different types of pizzas, as I'm trying to make the analogies with these different types of annuity contracts. So I thought that it would be cool to do a pizza challenge, and that's what I've done. So again, 5-star review, take a screenshot, send an email to realtalkpersonalfinance@gmail.com with your favorite pizza, and we will enter you in the drawing to win that e-gift card. All right, as I have in the past couple episodes, looks like we have another review that we're going to read here. This one says, number 6 podcast, been there and done that and is in my toolkit. Excellent podcast for beginning to moderate investors and good basic refresher for the experienced. Keep it real and keep it going. O-Dog, the money loop investor, with about 7 exclamation points after that. So thanks, O-Dog, for leaving a review. Shout out to you. Shout out to all the listeners. Feel free to take the pizza challenge. Hopefully you've enjoyed the mini-series on annuities. This concludes today's episode on variable annuities. We will see you in the next episode.
Check the mic and make sure it sound right, boys.